Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is another one of my continuing subscriber request series articles. I was asked to write about Levi Strauss, and this is going to be a very short video because as you see here, there's not a whole lot to talk about from a standpoint of historical fundamentals. The company first went public in 1971, but then the family regained control of the company and took it private again in 1985, and it stayed private for 30 plus years until March of this year, where it again had another public offering. They originally priced it at 17, and on the day it opened, it ended up closing around 22, I think it was. And I've got here, that was on March 17th. This is March 29th, 1919, where it actually closed at 23.55. And the reason I bring this up is, the reason I was willing to do this, even though I have no historical data here to speak of, we just have this, quote unquote, partial first year. Earnings are expected to come in at about $1.07, and they just had their fiscal year will end on the end of this month. And we're going to take a look at earnings here in a moment. Let's go into Seeking Alpha and take a real quick look at the company's earnings per share. You can see here that their August quarter, which ended in August, beat by 3 cents, and they also beat on revenues. And then the May quarter beat by 4 cents, and they also beat on revenues. And they'll be reporting in probably about 45 days now because it takes about that long. Their quarter ends in November. But so here's one of the reasons I went ahead and decided to do this, even though I don't have any information. It's a classic example of a public IPO. I'm not a big fan of IPOs because they always come out with hype and hysteria. This stock was priced at 17. It was up like 30-some% on the first day, opened in the mid-20s or low 20s, as I said. But since that time, if you look at it from its kind of, first month-end IPO date, the stock is actually down 27.6%, which is annualizing at 37, which don't pay much attention to that. It's really, truly down 27.6%, but it's now coming into a point where the current blended PE is about 16, 15.9. That's probably reasonable. It does offer a 3.2% dividend yield. The company has 40% debt and is rated BB+. Keep in mind now, this is I believe it's a 160-year-old company that's just gone public again. As far as forecast growth, earnings growth over the next couple of years is expected to average about 9%. So somewhere in this 15 to 16 PE ratio range would give us a stock that has the potential to do double-digit returns over the next couple of years, especially if it's popular. But, I think the big thing right now is it's got a very nice dividend. It is obviously a very well-established company. We just don't have any real fundamental historical data to back it up. We have some operating earnings and some diluted earnings that I can show you as far as this particular video is concerned. I don't have much in the way of others. We have some decent forecasts. Long-term forecasts are also interesting. If you look at the 3 to 5 year expected growth rate, analysts reporting to FactSet expect this is diluted earnings, about 4%. Let's look at operating earnings here. See what they expect. The actually adjusted operating earnings expect to grow at about 4%. If I go into Yahoo, for example, and look at what they think earnings are going to be over the next 5 years, they're saying 4%. So there seems to be a consensus on the 4% growth. Now, this is obviously an iconic company with iconic brands. The blue jean has been, an American staple since, certainly I was a little kid. And again, the company's been public twice now. This is the second time they've gone public. I do believe it's a strong company. I do believe it has potential. I think the price has finally, after the hype and hysteria of the IPO, the price has finally gotten to a point where it might make some decent sense again. So, those investors who are willing to kind of invest in a kind of a blind investment here. We really don't have any financial data going, any further back than March of this year. But the company does look attractive. It does look good. They seem to have a good balance sheet. So if you're interested in a dividend-paying stock with above average yield, over 3% yield, I certainly wouldn't tell you that you shouldn't take a look at Levi. But the biggest message I wanted you to get out of this was this idea that IPOs, this is very common for IPOs. Stocks come out, there's a lot of hype in the early days, and then, the IPO price tends to settle and the stock price ends up, going back into realistic valuations at some point after the IPO. So my advice on IPOs, no matter how excited you are, wait until maybe the first 6 months or a year after the company goes public, and then you might have a real good chance of buying at an attractive valuation. At least that's been my experience. Anyway, this is Chuck Arnevell saying thanks for watching. This is a subscriber request series. Someone wanted to ask me if I would do Levi. Again, not much to show you here, but I thought it would still be interesting from the IPO perspective story. If you like this video, don't forget to give us a like and also subscribe to our YouTube channel. We're going to be doing a lot of videos and covering hopefully some companies with a little more history than Levi does. But anyway, here's an old iconic brand that probably looks decent now. Thanks for watching.